Welcome to Johnson Wealth Advisors Podcast, Episode 3. I'm your financial planner, Elvis Johnson. And with me, I have the owner of Leggett Business Formation, my good friend, Ezra Davis.
Hey, glad to be here.
So thank you for coming today. So one big thing that I wanted to talk about today, I've been getting a lot of questions about this week or in the last week at a higher volume than normal. This question has been coming, oh my gosh, for couple of years now. It seems to come in waves, and it's about the infinite banking model, the bank on yourself movement. Ultimately, it's around life insurance and what other ways it can be used for. Have you heard of that at all?
Yeah, I think so. It's like an IUL or something like that.
Yeah, and that's one of the ways it can be used.
Okay. Is this where like you add like a bunch of riders onto a policy?
Not necessarily.
Okay.
You can add riders to a policy, and for those who don't know what a rider is like an option that you can add on to a life insurance policy. So I have kids. If I don't want to get my kids their own life insurance policy, I can add a child rider that will also cover my minor children.
Okay.
And it'll cover them at a smaller amount, but it will cover them. I can also add on a rider for long-term care. So that way I can, what's called an accelerated benefits rider. So I can use my life insurance while I'm living to help pay those care expenses because those things cost a lot. Assisted living facilities are just not cheap.
Right.
So you can use your death benefit now while you're living. You just use that, and that's a rider that you can add on. Okay. So it's not quite that, but what it is, you have to build the policy the right way and allow yourself the ability to take out money. And the great thing about it is, depending on how it's built, that money that you take out may be tax-free.
You got to pay that back though, right? Or no?
Again, depending on how it's built. So you can take a loan against your policy, or you can make a policy withdrawal that does not require any paybacks. Again, if you don't pay it back, it's just going to take it away from your death benefit. So when you pass, your beneficiaries get your death benefit minus whatever you've already taken.
All right. So you say you're getting this question a lot lately. Mm-hmm. Is there a problem with that?
Well, it's not necessarily a problem with the model or with the plan.
All right.
The problem is when you don't build it right. You know, there's no problem putting up a wall, but there could be a problem hanging a TV on that wall if there's no studs in that wall. Okay, so it all depends on what's underneath it. Okay, so with a life insurance policy, let's kind of back it up a little bit and just define life insurance policies, because that's important to kind of note. You have a policy that you rent. It's called term. 10, 20, 30 years, your term is over, no more life insurance.
Yeah.
Okay, you don't grow any cash value. It is going to be the cheapest possible way to get life insurance. And some people like using term. They say buy term and invest the difference. Okay, have you heard that plan before?
Can you explain that?
So when you buy term and invest the difference between what? Well, the difference between a whole policy, a policy you actually own, supposedly for life. And again, I say supposedly because there's a lot of things that can change in there. And within that, you grow cash value. Okay, so that's a permanent policy. The permanent policy is going to cost more because the life insurance company is going to cover you for the rest of your life, age 100 or 120, as opposed to for the next 20 years. Okay, so if the permanent policy costs $200 a month and the term policy costs $50, some people say pay the $50 and invest that difference, that $150 extra, because that's the pure cost of insurance. Others say, let me go ahead and pay that $200, and that $200 inside of that life insurance policy, it's possible that can be invested depending on what type of policy you get. So now we're getting into the IULs. There's also something called a VUL, or just a regular whole life policy.
What's a VUL?
So a VUL is a variable universal life. An IUL is an indexed universal life. And a whole life policy is basically just, it's a whole life, covers you for your whole life. But that cash only grows at a savings account rate, sometimes 3%. So the good thing about the whole policy is you can't lose money in them. It's guaranteed to grow 3%.
All right.
Another good thing about the IUL is you don't lose money in that either. You're protected against loss. But you're capped on your earnings. Okay. So depending on the market, it might be, let's say, like the market did last year in 2024. Market went up 25%. Well, some IULs have a cap of 12. So the person that had their money in an IUL went up 12%. But in 2022, when the market went down almost 20%, like 18, if I'm remembering the exact figure, that person in the IUL did not go down. That sounds pretty good.
All right.
Right? But then you got a VUL, the variable universal life policy. Now, that's where there's a differentiation, because you hear a lot on social media. Like, have you seen that about the IUL and Bank on Yourself movement?
Mm-hmm.
Those are all IULs. And unfortunately, a lot of times those people that are selling those policies are not licensed to talk to you about a VUL. So all they do is push an IUL. And it's not that the IUL is bad, don't get me wrong. But the VUL doesn't have a limit on your earnings, doesn't have that same 12% cap. And again, it's not always 12, so it could be 8, could be 10. But a VUL doesn't have that cap. So if you give someone the option, they might not want the program with the cap. I mean, which program? I also have to say that because there is no cap, you are actually participating in the investments. You can go down. So in 2022, if you were invested in the mutual funds that are inside of a VUL, the market went down, those mutual funds went down, you lost money. But when the market goes up, you don't have a cap. So you get all the gains and all the losses. So, I mean, it depends on your personality, which one that you prefer.
All right. So either you get like a little buffer, which means you have a ceiling, so you get a little foundation and a roof. But the other one, you get no foundation and
no roof.
No roof.
See, and the difference is you have to have not necessarily special licenses, but you have to have investment licenses to tell people about a VUL. And we just can't go out there and say anything that we want. We have to tell you that if you start a certain type of policy and you do what these infinite banking models want you to do, which is just upload just a bunch of cash into it up front to then be able to borrow from it. They always get really extravagant and say, oh, you can borrow buy your house and buy your cars with this. And then people come to me thinking that they're going to pay $300 a month. And all of a sudden, because it's a $500,000 policy, they're going to be able to borrow $500,000. And you can't. Not for many, many years.
Okay. So it's like a maturity type of, like what do you call that? Like a vested amount.
It's not necessarily vested.
All right.
It's like any other investment, just like any other investment accounts that people may have. It takes time to grow. Now, there is a surrender period where you don't get all of your cash value, where you just can't access it. And that's because these insurance companies have to make sure that they're going to make their money back. They pay me, the insurance producer. Again, I'm not a nonprofit. I don't do this for free, right? Well, we get paid for informing you and telling you about the policy, helping you find which one it is. Like, for example, I might shop it through 40 different carriers to find the best price for you. Well, they pay me. Okay. They also pay the underwriter. They also pay the case manager. They also pay the people that are just doing the document review. So the insurance companies put out some money, and they want to make sure that you're paying enough for enough time to where they can at least turn a profit. They're not nonprofit companies either. So there's a surrender penalty that you have if you take out too much money too fast. Okay. So you can't borrow all of that money right away.
Gotcha. What's a typical time? Like 3 years, 5 years?
Sometimes it's 7 to 10.
Really?
Yeah. So I mean, they think they're going to come in with all of this money, and a lot of people don't come in with all of this money. They think they're going to come in with a little bit of money, and all of a sudden have the ability to take a $500,000 loan because they got $1 million policy, and that's just not the case. But if they do have all this money, they can't put it all in at once anyway, because then it becomes a modified endowment contract, or as we call it in the industry, a MEC. And that is what you thoroughly want to avoid. 100% you want to avoid a MEC policy. So have you heard of that at all?
I've not. I'm assuming it's like acronym for something.
Yeah, so modified endowment contract is what that means. But that means you put in so much money so fast that the wonderful people at the IRS think you're using this life insurance vehicle as a retirement account. And because of that, whenever you take money out of it, including your death benefit, it's now going to be taxed.
And that's like a danger working with other people then who don't know maybe about these things and say, give me all this money up front. It's because you can end up getting taxed later.
If you don't build it right, yeah, you really can. But I don't know why they sell it like that. I think it's because they're not licensed in investments. So whenever all you have is a hammer, the answer to all your problems is a nail. Right? So there's that. And if someone wants to come in and put $50,000 into do a $50,000 annual premium into a life insurance policy, we get a really good commission. So you got to make sure that you're dealing with someone who's a fiduciary, all the time. Because if I'm out here selling stuff just for my commission, and I just don't tell you that you can possibly be taxed on all this money when you take it out, and I sold the policy to you, unfortunately with life insurance, that's not my fault. You can't, you have to be aware of all this. You're going to get all the paperwork about this too. You're going to get all the documents about this. Yes, I should have told you because I'm a fiduciary, but everybody's not a fiduciary. All a fiduciary means, for those who may not know, it means that we have the not only above my ethical responsibility to do what's in your best interest, we have the legal requirement to do what's in your best interest. So that's why whenever you're working with anybody to do with your money, make sure they're a fiduciary. Make sure they have a fiduciary standard behind them. So, but yeah, you can just really get screwed. And once it's a MEC, there's no coming back from that. That's for my sports fans, that's like the SMU NCAA death sentence, lack of institutional control. They're going to sanction and fine you to death. There's no coming back from a MEC once a policy is a MEC. You can't just you can transfer one policy if you had a life insurance policy and your needs have changed, like what often happens. Your needs change. You don't need this amount now. You need more now. You need less. Whatever it is, something's different. You don't lose all that cash value from policy A. You can do what's called a 1035 exchange and bring that cash value over to policy B. Okay, so you don't lose that money. Well, once policy A is a MEC, policy B is going to be a MEC. Until you just say, screw it, cash it out, let the IRS beat me. It's a thing.
Wow. So how do we avoid that? What's the minimum amount of payments? Or is it about consistent payments over time?
It's actually about a maximum.
Okay.
The minimum payment is the minimum payment required by the insurance company to keep your policy active.
Okay.
The maximum, it's called the 7-pay test. Some of it is called the cash accumulation test. There's a couple different tests that it has to abide by so your policy does not become a MEC. And that's what all the wonderful people behind me help me do. So I straight out, I don't do it all myself. As many people know, I have Angie with me. And by all means, again, please submit your questions. JohnsonWealthAdvisors.com. Let's talk. Ask your questions in there or submit them. Angela at JohnsonWealthAdvisors.com. submit your questions. We want to make sure we get them answered. Unfortunately, because I am licensed, like I mentioned, with all of those things, I cannot have comments on these videos. So you just got to submit your questions up for that. But it's like I said, there's a maximum. If you put in too much money too fast, that's when it becomes a mech. You really got to back it down or plan it properly. There's a couple different ways to get around it, so I know I'm not going to say it all, but you really have to plan it properly. And oftentimes when people come asking for that IUL, they end up asking, or we end up talking over some options, just like kind of we talking now. And have you ever heard the term LIRP?
Yeah, I heard about it, I don't know what it is.
Okay, so LIRP, L-I-R-P, Life Insurance Retirement Plan.
Okay.
That's basically where we are intentionally going into a policy for the purpose of taking out income while we're retired. A lot of times it's there to fund an early retirement. So someone wants to retire at 55. Well, if they touch their IRA before 59 and a half, penalized, right? So between 55 and let's just round it up to 60. There's 5 years where if you touch that IRA, you're going to get penalized. We can use a LIRP to fill that gap. But we have to plan for it. And we have to know, if I want to get this much out, then I need to put this much in. And that's not really for the people that are just saying, hey, I want a protection to cover my family. That's for the people that are already saving in their retirement accounts, are already have a proper, good general rainy day savings fund. You're already investing. You're already doing the foundational things and even maybe a little bit more. And then you can get fancy with a LIRP. But yeah, that's it. It can be used to supplement retirement income as well. But again, that's an advanced planning tool, and it just requires a lot more conversation than we're going to have time for right now. But so yeah, it can get extremely picky.
Well, we're going to talk about that later.
So for example, I have a client right now. They don't want to work till 60. Common story. I'm pretty sure someone out there is going to relate to this. I don't want to work all my life, right? They want to retire early. Well, I asked this person, how early? And they said, they're very young, but they said, I don't want to work past 30, 35.
Hey,
okay, wonderful.
Get it.
And so I said, okay, we can do that. It's going to take this much money a month, and they were like, ooh, what about 45? So I said, okay, 45 will take this much money a month. It's still not a small amount of money, but we have to change the death benefit to make sure we're buying enough life insurance so the IRS stays off your butt. It's almost like driving down the freeway. You're going 59 miles an hour, you're fine. You're going 60, you're fine. Let's say the speed limit is 60. And the cop won't mess with you if you're going 65. He sees you going 65. He knows you're technically speeding, but he won't mess with you. But 67, now I'm going to pull you over. I'll give you this, but if you take that, now I gotta get you. It's almost like what the IRS does. They'll give you some. They understand what the product is. They know it. We're not sneaking one by them, but just don't be greedy. That's essentially what it does.
I gotcha. Interesting.
Yeah, and so now that person is going to be able to put in, again, a lot of money every month or every year, depending on how they want to do it, for a number of years. And then they will literally be able to retire much earlier than most and have income coming to them every year because we've taken the time and planned it. And they'll have that income coming to them. For them, the way we're writing it, it's tax-free. That's the beautiful part. So, there's just so many options with life insurance. I know we've talked on, you don't have any kids, so it's not necessarily a thing, but for people with kids, I bring up life insurance with kids and they go, oh no, because we think of life insurance typically as what?
You're going to plan for death.
Right. And so no one wants to plan for their kid's death.
Right.
But what about planning for life? Because my daughter now has a policy. She's 1.5 years old. And I said, okay, I want her to be able to have $25,000 by the time she's 20. but I only want to pay for it for 10 years. So that's what it is. We wrote the policy. I said, these are my guidelines. I'm paying for it until she's 10 years old. By age 25, she'll have she'll have $25,000 in cash value. If she doesn't touch it, the money will continue to grow. And my purpose of it is now she has a $400,000 death benefit that she goes out and gets married and meets a guy. Okay, great. That's one less expense that she has to cover. That's, oh, hey, Dad, help me out with a down payment on my house. Hey, look at that cash value. I gave it to you a long time ago. And I don't got to reach in my wallet and give it to the kids. So it's not just about death, it's about life. So there's so many options when it comes to life insurance. It can be a very important tool, So, yeah.
Uh-huh.
Well, I want to keep droning on. Do you have anything else that you wanted me to touch on that, or any question that wasn't clear that maybe you think people may not have fully grasped without trying to get super technical?
No, I'm just trying to wrap my head around some of it. I'm like, I really want a VUL.
It depends. They're both fine.
Yeah.
It's not that one's bad. It's just one's better for you.
Yeah. I got that. I've heard about IULs a bunch.
Mm-hmm.
So yeah, it's kind of new information for me.
Got it. And that's the thing out there for people. Make sure that you're getting your information from qualified people. There's various ways to look them up and check them out. But make sure that the person you're talking to doesn't just have a hammer. If you keep going to them and all they keep saying is nail, ask them about their tool bag. If all they got is a hammer, that is what it is. And like I said, just a shameless plug. We got hammers, we got drills, we got rubber mallets. We got the sandpaper. So it doesn't matter whatever the need is. We got a financial tool for it. And if I don't have it, I'll point you in the right direction. So. But yes, submit your questions through the website, johnsonwealthadvisors.com. Like this video, that helps us out a lot. And, I want to make sure that we're answering your questions. So, please go to the website, submit your questions. Again, I'm Elvis Johnson Wealth Advisors here in Lakewood, Washington, with my good friend Ezra Davis, owner of
Leggett LLP. And I hope you check us out. You can find us at leggettbusiness.com.